A very good evening to all friends. Myself, Sanjeev Singhal, Central Council Member and Chairman Auditing and Assurance Standard Board and Chairman Sustainability Reporting Standard Board. I welcome you along with my Vice Chairman, CA Vishal Doshi ji, Central Council Member from Baroda. We welcome you to this web series on the various auditing standards because the audit season is going on. So we thought it will be fit that we once again reiterate the principles in the various auditing standards. Today is the 29th program for the AASB for this council year. Last month, we organized 18 programs on bank audit. And then in March and in April and May, we have done 11 webinars on the various auditing standards. Our speakers for the day are CA Aleem Lilani and CA Yusuf Kagalwala, both very renowned speakers. The topic for the day are three auditing standards, SA 700, SA 705, and SA 706. SA 700 speaks about forming an opinion and reporting on the financial statements. Friends, when an auditor has done, the final step is to issue an audit report. For issuing an audit report, he needs to form an opinion. These three standards are interrelated. As we said, SA 700 talks about forming an opinion. SA 705 talks about modification to the opinion independent auditor report. And SA 706 talk about emphasis of matter paragraph and other matter paragraph in the independent auditor report. And then there is one more essay, which is SA 701, which talks about CAM, the key audit matters. I welcome our Honorable Past President K. Raghuji. Sir, we welcome you to this webinar and thank you for taking out time, sir. Already 1400 plus members have joined. And so this is our 29th program of the AASB in this council year. In March, we organized 18 programs, and this is the 11th webinar on auditing standards. So friend, as I was talking about, these three standards plus SA 701 on CAM are interrelated. Because when an auditor has done his audit work, he needs to decide what kind of audit report is to be issued. The audit report could be unqualified or audit report could be qualified. It could also contain opinion or a disclaimer of opinion. Primarily, we divide all audit reports into two types. One is unmodified report, which is equivalent to an unqualified report. And second is a modified audit report. A modified audit report where some modification to the normal audit reports have been done. And a modified audit report can take form of an adverse opinion, a disclaimer of opinion, or a qualified opinion. An adverse opinion is expressed when the deviations or the misstatements in the financial statement are material and pervasive, so that they do not reflect a true and fair view of the state of affair of the financial statement and the financial position of the enterprise. We issue a disclaimer of opinion as an auditor when the auditor is unable to express an opinion. In that case, disclaimer of opinion is issued. There could be various reasons for expressing a disclaimer of opinion. Now, a qualified report normally means qualification is with respect to certain aspects in the financial statements. It could relate to, and that to certain material aspects. Could be inventory, could be receivable, could be fixed assets, could be revenue, could be expenses. But these are not pervasive. That is, they do not impact the very large number of items in the financial statement. Then we do a qualified opinion. As I said a short while ago, if it is material and pervasive, then we express an adverse opinion. So these three auditing standards, along with SA 701 and CAM, is applicable in respect of listed entities only. So from the perspective of an unlisted entities, these three standards are very important. And of course, there is one more auditing standard, which is SS 720, which also forms part of an auditor report. We are covering these three standards today so as to give a basic flavor about the audit report. It's very, very important that if an emphasis of matter is also given, an auditor carefully examines that whether the item should fall into CAM or a qualified opinion, because these three things are not the substitute of one another. It's not possible that you want to give a qualification, but you give an emphasis of matter, or vice versa, that you want to give an emphasis of matter, but where a qualification is required. An emphasis of matter is given when you want to emphasize on a particular matter, for example, going concern, without qualifying the accounts. So it's very important that as an auditor, you make this selection very and form your opinion accordingly. It's an audit season, as I said. A number of audit reports will be issued. There are about 14 lakh companies. All will undergo the audits. And to discuss these audit reports, this program has been organized, and I'm so thankful to our Honorable Past President, C.A. K. Raghuji, who has agreed to be a keynote speaker. And let me tell you what a person he is. If you give him a topic, he will thoroughly study, and then he will come as a keynote speaker. I had the good fortune of working with him when he was president. I was a special invitee in NACAS, and even otherwise during his council term, I had the opportunity to be a member of some of the committees of the Institute of Chartered Accountant of India. Raghu sir has been born and brought up in Bangalore, completed his graduation from the prestigious St. Joseph's College of Commerce. He became a chartered accountant in year 1990 and was elected at the highest position in the Institute of Chartered Accountant of India as president in year 2014-15. He's an honorary member of the CPE Australia, senior partner of. He specializes in taxation, audit, business, investment, and technology. And during his term in the council, he acted as a transformation leader and focused a lot on technology. He has been a member of Central Council from 2007 for 3 consecutive terms. He's also been a former director on the board of Indian Overseas Bank, former board member of the IFAC in New York, and member of the audit committee of the IFAC for 2015, and chairman of the CSR committee of the ICAI. Internationally, he has held the position of technical advisor on the board of IFAC, member on the board of CAPA, chairman of the Committee on Education, Training and CPD of South Asian, which is SAFA, technical advisor on SAFA, technical advisor to POODC of IFAC, member of the SAFA Assembly, member of Membership Development Committee of XBRL International. He has also been a mentor of New York chapter of the ICAI. Nationally, he has been a member of the IRDA, a member of NACAS, member of the High-Level Steering Committee for Implementation of XBRL-based data submission by bank, member of the working group constituted by the Ministry of Corporate Affairs in the areas of corporate governance, CSR, and other aspects of corporate affairs, member of the task force in the Ministry of Corporate Affairs, in regard to the planned budget of the ministry for 12th 5-year plan, member of the advisory committee on mutual fund of SEBI, member of the MCA 21 stakeholder committee constituted by MCA for ensuring continuous improvements in service delivery under MCA, and then is a member of the QRB, and then regulating monitoring committee of NBFCs in Karnataka, and recently he also became a president of the Karnataka Cricket Association, and he has spearheaded so many committees. There's hardly any area that has not been benefited by Sir's expertise, whether it is insurance, whether it is banking, whether it is Companies Act, national or international. So we salute you, sir, for your contribution to the profession and express our sincere thanks for your kind presence, and would request you to kindly deliver your keynote address. Thank you, and over to you, sir.
Yeah, thank you, Sanjeev. Good evening to all the participants participating in this program, a seminar, you could say, virtual CPE seminar on audit conclusions and reporting. I'm extremely thankful to my good friend Sanjeev Singhal, a very dedicated council member from Delhi, who has been doing a lot of work in the council. I've been seeing he got elected for the second term with the highest number of votes for the second time. And what I find in Sanjeev Singhal is that his commitment to the profession, his commitment to the council is very, very high. As Sanjeev rightly said, even before he entered the council, he was very active in many technical committees of the institute, and he comes with an academic background. And when I met him for the first time, I still remember he gave me two volumes of IFRS, and he told me, Mr. Raghu, this is for you, please go through it. That is a kind of knowledge sharing Mr. Sanjeev Singhal has been doing for the last maybe 2 decades. Thank you, Mr. Sanjeev, for having invited me to this webinar, a very, very useful, informative webinar with so many changes taking place in reporting. I think very rightly you've gone about identifying these 3 standards, 700, 705, and 706, which are very relevant, important, and for members of our profession to keep in mind as to how they should go about discharging their duties as an auditor, how exactly they should go about reporting, what are the modifications to the opinion that they have to give in case they want to qualify the report. So I think it's a very relevant session. Friends, having said this, I can only say that, we've had tough, challenging times last 2 years due to COVID. Economy is slowly bouncing back, and we see a lot of business activity coming back to its original, you can say, pre-COVID times. But yes, a lot of challenges for the profession also. Challenges which we have very successfully encountered. And Sanjeev Singhal, I should compliment you personally, Sanjeev, for the kind of effort you have taken in a city like Delhi to support a lot of CAs in distress by setting up your helpline for providing oxygen support, providing support to them in getting admission to various hospitals. Sanjeev has been very, very active, and I used to get all his messages. And thanks to you, Sanjeev, from the bottom of my heart, for the good work you're doing for the needy, especially during COVID times. You had put a lot of effort, and I really compliment you. Friends, having been the president of the institute in 2014-15, I had the opportunity of serving on the International Federation of Accountants for 2015 to 18, immediately after my presidentship. And when I served as the board member of the International Federation of Accountants, I had the opportunity of interacting with the chairman of the AASB. We have Auditing National Standards Board as a committee of IFAC. And this committee, once it's did the final draft, there are some informal interaction with the board members, and then there's a formal presentation by the chairman of AASB and to the IFAC board. And we know the stringent standard setting process, what is being followed, and the kind of deliberations that take place in the AASB in IFAC. And I'm very happy that India has got a strong representation in the AASB, and they're able to contribute a lot to the entire auditing standards preparation. And let me tell you, friends, IFAC has a very robust mechanism, like how we expose the standards in India, auditing standards, when it is formulated. Similarly, we have a robust mechanism where it is exposed to various member bodies, various jurisdictions around the world. We try to understand auditing practices in each location, try to understand what are the challenges, and try to finally come up with an auditing standard that would be useful to the members of the profession in that respective jurisdiction. It's a very, very tough and challenging job. But having served in IFAC, having seen how AASB works, I can only say that yes, AASB has been doing a tremendous job as far as the global thing is concerned. As far as ASB of the Institute of Chartered Accountants of India under the chairmanship of Sanjeev Singhal, and we also have the vice chairman. We have a new vice chairman, Sir Vishal Doshi, who have been doing an excellent job. They've set out an agenda. I've happened to see their agenda, exciting agenda, and I'm sure they'll be able to complete the agenda that they've set before them for the current year. Today, what is happening, friends, is that, yes, we have a lot of, you can say, stakeholders looking at the profession. We have the regulators pouncing on us for not discovering the frauds. And AASB has been doing an excellent job in formulating auditing standards that's relevant to our country. And I can only say that I've gone through most of the standards that are on par with all the international global accounting standards. And one thing I can tell you here is that the standards that have been formulated by the AASB have also gone through a rigorous standard setting process. It is exposed to the public, it is exposed to academicians, exposed to the council members, deliberated. The AASB primarily takes the initiative to formulate the standards, and it goes through a whole process. And because of that, we're able to get a wide acceptance to these standards. And I can only say that our standards are on par with the global auditing standard that is issued by IFAC. Friends, in addition to formulating standards, the Auditing and Assurance Standards Board also reviews existing standards. They look at the various changing audit practices that are prevalent in India. And finally, they come out with all the engagement and quality control standards. The main, I think the contribution is the formulation of the guidance notes, which are very, very relevant. I do remember I've gone through many of the guidance notes, that has come out by this committee, and I wish to compliment Sanjeev Singhal for the technical guides, the industry-specific guides, the guidance notes, which act as a sort of a guide to the members to carry out their duties as an auditor effectively. Plenty of research activities are also happening. A lot of knowledge dissemination. This seminar I've been given to understand now more than 2,500 people are watching the seminar online. And I know I've been in the council. I know how difficult it is to get an audience. For a taxation seminar, you get, good lot of people. But for a seminar auditing seminar, we always find it difficult. Members of the profession are not very keen to attend the seminar. But Sanjeev Singhal has been able to get about 2,500 people every day. Extremely good. And another important thing with AASB is doing is interacting with the regulator, whether it's RBI, whether it's SEBI, whether it's Ministry of Corporate Affairs, whether it's IRDA. They've been constantly talking to them, trying to get their feedback, trying to understand their expectations, and try to see if they're able to match with what the stakeholders want. And this is very important, very critical. The Institute has been doing it. And AASB, I'm sure, is taking all the regulators into confidence so that the trust factor, what is always, looked upon in the profession, keeps moving higher. They're able to place more reliance on the work that is done by the audit profession. And as you all know, the AASB has council members and representatives from Indian Institute of Management, FICCI, ASSOCHEM, technical experts are there. When we come out with standards, we have technical experts also contributing. And I'm given to understand almost 34 guidance notes, 17 implementation guides, and 11 technical guides are there. These are all available online. And I can only say that these publications are available to you, and you should be in a position to, sort of read through it and, try to empower your audit teams. Friends, what I personally feel, myself running a small and medium, being a small and medium practitioner, I think a lot of time we should spend on training our staff. That is very, very important. That is what we find is lacking. So in addition to upskilling yourself, in addition to knowing the new standards, you should have your in-house training programs continuously happening at your offices. Try to see that the senior team, the audit team is, conducting these activities for the staff in the organization. They're completely updated on the developments taking place, in addition to attending the programs of the institute. So upskilling is very critical, not only for you, but each and every staff member of your organization. If you're handling listed company audits, all the more critical, all the more important, because you are subjected to greater scrutiny. And whenever listed company audits are being undertaken by you, the kind of regulatory, you can say regulatory control that will be there on this listed companies. In addition to that, we also have the FRRB that picks up balance sheets of various listed companies to find out whether you've done an audit properly, whether you've applied the auditing standards. We have the peer review board that looks into whether you've done your audit engagements well. So we have the peer review mechanism, we have the financial reporting review board mechanism, we have the quality review board mechanism, which looks into the quality of work that goes in when you discharge your duty as an auditing professional. So my request to each one of you watching this seminar, is a very useful seminar, very relevant, topical. And if you are able to update yourself on these auditing standards, definitely I can assure you that the quality of audit would go up, because today the regulators, the stakeholders have the feeling that the quality of audit is not up to the mark. And especially so when we conduct audit of banks, all the more this is pronounced, because I have been a director of a nationalized bank. And when we go for the meeting with Reserve Bank of India, always the question is the quality of the bank audits being conducted by our members. So when we talk about quality is very important, very critical. All regulators expect you to do a high level audit, a good quality audit. And if some fraud is discovered, something goes wrong, the first thing that happens is, rather than questioning the promoter, they ask, what was the auditor doing? Why did the auditor not qualify? What is the reason? Why has he given a clean report? why there's no mention that has been made in the audit report. So these are some of the things that we have seen, and the AASB have very rightly come out with these standards that will give much better quality of reporting. You're able to tell the user of the financial statement and user of these reports to tell exactly what is wrong in the company, whether any material misstatements are there, whether any qualified opinion, everything comes out very clearly. Friends, finally, I personally feel auditing standards improve the quality of audit, and because of that, that improves the quality of financial reporting itself. Financial reporting is something which is very important for every organization. Have very sound financial reporting. Good financial reporting is required for a country like India, which is growing very fast. And I believe auditing standard paves the way for high quality financial reporting. In addition to this, it provides broad guidelines to all the chartered accountant firms, all the CAs who are conducting audit. Generally, there's a feeling that, it's only in the big multinational accounting firm that, high quality audits take place. I would definitely believe that a lot of firms, Indian firms, have very high quality skilled resources, which, provide good quality services. And I believe that audit engagements can be carried out more effectively if you're able to follow the standard that has been pronounced by AASB. And another important thing which we need to keep in mind is, once we tell the regulators that our members are following the standard that have been formulated by us, approved by us, it gives them more confidence on the assurance engagement that you have performed. And it gives a confidence to the stakeholders that everything is fine. The auditors looked into all the aspects of true and fair and given his report. So it's absolutely essential. You should keep that as, a sort of when you're carrying out an audit, a sort of a Bible. These standards will produce the right way for you to move forward. Coming to the responsibility of the management, responsibility of the auditor, many questions come up for many issues. And these standards tell you what is your responsibility, what is the management responsibility. It very clearly gives you illustrations for you to understand. And finally, what I personally feel is that the standards regulate the quality of audit. That is, the entire audit activity is regulated through these standards, and that brings about a lot of uniformity when audits are being conducted on various listed companies across the country. Friends, today the standards on auditing is mandatory. Sanjeev Singhal very rightly said, guidance notes are recommendatory, but whenever you are not able to follow what the guidance note has been said, for whatever reason, you need to appropriately disclose. And when it comes to other technical guides, it's purely recommendatory in nature. So this is something which you need to keep in mind. And we find that when you apply these, technical standards in the course of your audit, you'll be able to, provide a high quality audit to the stakeholders. And I'm sure your services will be recognized very well by, the company which is appointing you, the investor, the stakeholders, because as I told you, your audit report is subject to public scrutiny. It can be challenged, it could be questioned by regulator. So you need to do your job very effectively. Coming to the, Sanjeev talked about 700, forming an opinion and reporting on financial statements, a very important standard. You can say it's a mother standard where the entire format of the audit report, how you need to go about, what exactly is the reason we form an opinion, how we go about forming an opinion, everything is given in this particular standard. 705 talks about modification to the opinion in the independent auditor's report, which is very, very critical. And then 706 talks about emphasis of matter paragraph and other matter paragraph in the independent auditor's report. All these three standards give you guidance as to how you should go about issuing the audit report. Friends, one thing please keep in mind, many a times we find that an audit report are being given that very limited time is spent on preparing the audit report. A lot of time is spent on the financials, doing a review. But when it comes to the final, the 10, 12 page audit report, please ensure that each and every word you look into it, and it's just not a cut, copy, paste job. And many times it happens, knowingly, unknowingly, you have your junior staff picking up the last year's report and just copying, and it might get overlooked. So please ensure that you spend quality time on every report that is issued by you. Proper qualifications are made. Wherever there is a modification opinion needs to be given in the audit report, has to be given. And Sanjeev has given out his thoughts very nicely as to how you should go about doing your responsibilities. And two projects which I found very interesting and exciting is which the AASB has planned is digital assurance. Today, what is happening, friends, is that we are seeing a digital revolution. A whole lot of services and products are being sold online. Today, you want to buy an air ticket, you want to buy a tie, you want to buy groceries, you want to hail an auto, you just use an app, you're buying it online, buying a TV, everything has become online. The entire e-commerce has taken a lot of, you can say, gained a lot of momentum. And as a result of which today, you find most of the companies are offering their products and services online in addition to the brick and mortar model. Here, what is important is that giving a digital assurance to the client. Today, let us say you have an e-commerce client selling, apparel across the country, and people are buying apparel on the portal, and they're making the payments to the payment gateway. Deliveries are happening from many locations. It is you as an auditor who has to give an assurance to the management that everything, all the digital transactions that are happening are all proper. Everything is being recorded properly. All the payments are coming in for all the sales that is being made. Deliveries are happening in a very systematic fashion. But digital assurance can be given only by an auditor. An auditor is the right person. No other professional will have the capability, will have the confidence to say that everything is happening fine. So if you are the auditor of a company, a technology company, if you're auditor of a fintech company, if you're auditor of a IT company, if you're auditor of a e-commerce company, I think digital assurance plays a very big role. And today, web trust audit is gaining momentum around the world. What do you mean by web trust audit? All the transactions happening on the net are verified by you on an online real-time basis. Now, blockchain is coming in a big way. Blockchain applications would help you to conduct an audit on an online real-time basis. I remember having seen a presentation of how auditing is done in a blockchain environment in one presentation in New York by IBM during one of our board meetings. We were taken to the IBM headquarters, and we were demonstrated as to how audit would undergo change in a blockchain. Let me tell you, friends, blockchain is coming to India in a very big way. And the banking sector would be the first sector to embrace blockchain. And once blockchain comes, you need to completely reorient yourself. Your audit skill set should change. You'll be able to give the digital assurance what Mr. Sanjeev is promising to the stakeholders can be given to you very, very effectively if the organization is using blockchain and you're using tools that can help you to audit in a blockchain environment. And let me tell you, it's extremely futuristic, and it's just not possible for you to just pick up this skill set just like that. You need to go through an intensive training program. You need to understand the technology well, and then you are able to, sort of use audit tools in a blockchain environment to give the digital assurance to the management that everything is fine in the company. Exciting project, Sanjeev Bhai. And please let me know any support from my side for this project. I'm welcome. This is something very close to my heart. I have, as you know very well, and as you rightly said, I've been promoting digital education and digitization right from my presidentship. We had the mobile app, we had so many, we had the cloud campus, we had the ICA TV. Today, all the webinars are happening online thanks to the technology that was introduced in 2014. And you're able to buy publications online. And I have a passion for technology. And I would definitely like to associate myself in this particular project on digital assurance, because I feel I can also give my thoughts, my ideas to this particular project.
Sure, sir. So, sir, very soon then you will receive an email. We are planning a meeting on Monday morning of the group on digital assurance. Sir.
Thank you very much. And then coming to the guidance note on Karo, which they're planning, also very relevant, very important. I'm sure that will come out as quickly as possible because members would.
Sir, guidance note is already there. We are just making some changes in that.
Right. That has come out in 2020, if I'm not mistaken.
Yes, sir. It came, but now because of the Schedule 3, some changes are required. So we are coming out with those changes.
And the third project which your committee has planned is the Audit Checklist. Auditing standard checklist for practitioner. I think that's very relevant, very useful, because ultimately you're looking at a whole lot of small and medium practitioners in our country. So we're looking at big volumes, maybe 40,000 firms, 50,000 firms, and almost into 10, about 5 lakh article clerks working, auditing companies. I think a checklist like this would be very handy, and that will help them to, sort of carry out their audit more effectively, ensure that all these standards have been complied with. And my sincere suggestion to you, Sanjeev Bhai, is to see that this checklist is made online. So what I need to do is I need to have a small utility. I key in the name of the client, and the checklist will help me to enable me to key in all the important information that is required. Whether I've done this, whether I've done that. And at the end, once I put my, when I conclude, I say, yes, you're complied with all this. This 7 is not complied with, 8 is not, it should prompt me. So this is something, the auditing standard checklist for practice is very good, but please make it, an online, sort of a checklist that will help us to ensure that all the checkboxes are ticked. We do the audit, and I'm sure, I'm very confident that your committee will do a good job in helping all of us to perform our audit better, and as a result of which the quality of our work will be respected, and a lot of trust that has been placed in the profession by the regulators, and it's our duty to see and convince the regulators, yes, we are marching ahead, we are trying to handle the vendors, we're trying to train them, we know what is happening globally, what are the future trends in auditing, that auditing is happening. I'm sure that the future of accounting and future of auditing is so nice. And in one of my recent articles in the April issue of the newsletter, I talked about the creation of the next gen firms. See, all of us have been traditionally into audit and taxation, but I've talked about, I've given an article as to how technology could be an enabler for you to carry out audits. Even for stock taking can be done by using drones. We talked about a lot of new emerging technologies, and I'm sure each and every member watching this webinar, one suggestion to all of you is that yes, you need to build a next generation CA firm. You can't just be happy with your traditional type of firm. You need to build the next generation of, get into forensic audit, get into insolvency, get into a lot of new areas that is opening up for the profession, IFRS. And I can assure you, and I can say there's a lot of opportunity for profession, and the future for the profession is exciting. Thank you, Sanjeev Bhai, for having invited me. And I wish all the members good luck in this great learning experience. Thank you.
Thank you so much, sir. I would just like to add one or two things, sir. In our AASB this year, we also have a representation from RBI, from Security Exchange Board of India, from IRDA, from Indian Banker Association, from Enforcement Directorate, from SFIO, and from Central Board of Direct Taxes. We want to tell them that how transparently we work and how conscious we are about the audit quality, and their inputs will be duly considered. So this will build a confidence between the various regulators and our members. And sir, we are also doing a project on expectation gap. There's a paper from IAASB dividing the expectation gap between knowledge gap, performance gap, and an evolution gap. So we are looking at that, how do we bridge this gap between what the government and society expects from the auditor and what is generally done. Although we believe that the new CARO will bridge a lot of that expectation gap, but still, if there are any areas left, we will seek to address that as well. Thank you for your kind words, sir. And thank you for showing the path as always. Extremely delighted to have you, sir, as a keynote speaker. And now we will move.
Thank you.
For two speakers, CA Alim Lelani and CA Yusuf Kagalwala. Okay, so I request CA Alimji to kindly start the deliberation.
Yes, good evening, everyone. I believe I'm audible, sir?
Yes, you are audible.
Great. First of all, I'll extend a very, I can express my gratitude for being here and speaking on this topic, because the auditing standards have always been one of my core areas, and it is a sense of great pride for me to today tell everyone about the new standard. I mean, it was revised a couple of years ago, but the new standard has got so much, and it is so clear with what you have to report, how you have to report, that you cannot go wrong. I personally feel if you read the standard very carefully and follow it to the T, you cannot go wrong here. So the new standard is very descriptive, very, very objective, and I'm happy to take everyone through this. And I hope that by the end of the session, everyone has something to take back as a reference, as a quick reference, and it stays in the mind that everyone, when you make your reports, it clicks and that, okay, this can be done in a certain manner. We can use this kind of a procedure and get this done properly, documented properly. So first, many thanks for you to allowing me to take the session. And it was a very enlightening talk by both of you. I've learned so much about the profession, and I'm myself feeling excited that when we look at blockchain and how it takes over the audit profession and how we do it through a complete 100% check system is going to be really amazing to watch. Great. So without wasting much time, I'll share my screen and start off. If someone can just confirm that the screen is shared and visible to everyone, I can start off.
Yes. Yes, Salim.
Okay. We talk of Standard of Auditing 700 revised, the most core, most important document for an auditor, the ultimate proof of our work, our statement of our work is this standard which governs the audit report. Now, when I recollect my earlier days as an article trainee, I often question my principal, my partner, that, sir, we do so much work and your report is just one page. And I think perhaps God listened to me, and today we have a long report with so much said inside it, all about the management, about the auditor's responsibility. We have CARO, we have 143, 3 reporting expanding like anything with the additional requirements, now 11E, 11F coming into place. So perhaps God listened to me, and after so many years, finally we're seeing a report becoming more elaborate, documenting everything that we do as auditors. And it's such a proud thing that when we present it to someone, it looks that, okay, so much of work has been done in auditing, which many people, many clients undermine the work that we do. So what I will do today, let's move forward and let's look at how the audit report is supposed to unfold and what are the data capture points, how do you go about it. It's just a brief of how I will take the presentation. I'll be keeping in mind the time, of course, and I'll just touch upon these topics. I'll talk more so that it's a very quick pick for you, each of you. We won't go very much into reading the presentation, but broadly, I would like to cover these points. We'll talk about how do you express an unmodified opinion, what needs to be taken care of. We need to see some of the important terms that are used in the audit report. What is the requisite to issue the audit report? Finally, the contents of an audit report, very specifically laid down in the standard. None of them can be missed. It has to be that way. Finally, when we issue the audit report, before issue, what we need to take care from as an auditor, as from a documentation point of view also. And that's the part of the audit report. And rest I'll talk about reporting under 143.3, which is the additional requirements, the new reporting that has come on 11E and 11F. And I'll also talk about the many publications of ICI, which can help you directly when drafting your audit report. All right, so like I said, we have standard 700. The 700 deals particularly with the auditor's responsibility to form the opinion on the financial statements. When you read the standard, you will see that all it deals with is the reporting responsibility. We have other standards as well, which come and sit or come and work on 700, but 700 is the core standard. So when you go about the audit, the first job you have to do is you have to make an SA700 report. Once that report is ready, once you have covered every element of SA700, then you bring upon the other standards, 705, 701, 720, and those come and sit on the SA700 format with certain tweaks. And the relevant standards have mention of the way, the manner in which you have to report, the manner in which you put an EOM or a CAM, a key audit matter or an other matter para. So those are all defined in the respective standards, but SA700 becomes the base on which you start putting in the various other kind of reporting that come in. So the starting point for any audit, you take up 700, ensure compliance with 700, and then move on to 720, 705, and the various interpretations in those standards. So that's a small piece of advice. Start with 700, then go to the other standards. A common mistake made is we go to the other standards, we pick up an illustrative from there, and we may realize that, okay, we maybe missed something, because those standards also say that you have to go and refer to SA700. They do not take complete onus on the report format. Okay, so very important for us is SA700. The 700 is aligned with ISA 700. So that means that we are now aligned with the IASB standard, the IFAC reporting standard, and our reports today are comparable with any report across the globe. The very good thing that the revision of ISA 700 that happened in 2018, it was a difficult process, I remember, Clients were concerned, auditors were concerned, how would we report, how would we go about it? But it took away a lot of ambiguity in reporting. Earlier, we had statements in reports which said to be read, like the opinions had lines like to be read with note number so-and-so. We don't know to be read with note number so-and-so, whether it's a qualification, whether it is just an EOM, emphasis of matter. There was a lot of confusion. So what SA700 revised did is took out all the confusion. So now we have an opinion para which cannot be touched. It is sacrosanct. The opinion para is fixed in its language. Either it is a clean opinion, a qualified opinion, an adverse opinion, or a disclaimer. There is no other interpretation of the opinion para. Whatever has to be said in a separate para, and that para also needs to have a title. So it has to be a basis of a qualified opinion para, a basis of an adverse opinion para. So the title itself talks about the matter, indicates the matter inserted in the para. So there is no ambiguity. Nobody can make a mistake on reading that information in the para, whether it is, whether it is really a qualification or the auditor is just trying to draw a thin line between a qualification and an emphasis of the matter. So we'll see about that a little later as well. So from the year 18, so from the year April 18, from 1st April 1819, the reports have been standardized. Many paras are now defined with headings. So there is no ambiguity in the audit report anymore. And like I said, we have many other standards. There's a 570 like going concern. If any matter on going concern reporting, it's mentioned in these standards, which can then go and fit inside the SA700 report. Similarly, 720 and 701, I mean, yes, it goes on, all the other standards. A very distinguishing feature of SA700 is that it applies to a general purpose financial statements. When I say a general purpose financial statement, it is a financial statement that can be given to multiple number of people. It is prepared for a general purpose. Now, when we talk about general purpose is defined as financial statement prepared in accordance with a general purpose framework. And what is a general purpose framework? A financial reporting framework designed to meet the common financial information needs of a wide range of users. Now, I'll break this very clear for everyone. Either you have a general purpose financial statement or you have a special purpose financial statement. Now, a special purpose financial statement is prepared under a special purpose framework. A special purpose framework is either defined by any particular regulator or statute, or it may be defined by a particular management or a particular class of investors. Now, it is made for a particular purpose, let's say a tax authority or a particular group of investors or for the management. Then that report cannot be used for any other purpose. It is always disclaimed. So 700 deals with a general purpose financial statement. It should go to everyone. It can be given to the bank. It can be given to the creditor. It can be given to the shareholder. It can be given to the members. The same report. But when you talk about a special purpose report, if a client wants an audit done by you for a specific purpose, then that is called as 800. That falls under SA 800, where it comes under a special purpose framework, and 805 deals with specific considerations for audit of a single element of a financial statement, like maybe just a balance sheet or a profit and loss account or a trial balance or a particular few financial statement areas. So what we will discuss today is a 700, but just keep this in mind. If the client requests for you of a report for a specific purpose, please don't go to 700, please go to 800 or 805. Largely 90% the formats are the same, but you need to still follow 800 and 805. Okay. The audit report now breaks up into two parts. Okay. One is reporting on the audit of the financial statement. That part talks about the opinion, basis of opinion, responsibilities, emphasis of matters, other matter, and closes off. That typically deals with your true and fair view. The other part of the report that is acknowledged is the report on other legal and regulatory requirement. That comes below. There we will have any particular reporting prescribed by the legal regulator. The most famous being the Companies Act. The Companies Act has a 143(3) section, which talks about additional reporting by the auditor for every company. So we have that in the report on other legal and regulatory requirements. There we also have CARO, we have the IFC reporting, we have the new 11E, 11F reporting that has come in, and you are also open to report any non-compliance with the legal requirements there, because that non-compliance may not affect the true and fair view, but from a compliance point of view, it may have a bearing on the report. You may want to report it. Now, we'll look at them. So this is the first part. One of the very common understandings required is a fair there are two frameworks that work. One is a fair presentation framework and one is a compliance framework. When you look at a fair presentation framework, the word itself, fair, denotes, when it hits our head, the true and fair view that we always speak about. So the Companies Act requires us to provide an audit report on the financial statements to give a true and fair view. So we are largely dealing with a fair presentation framework. Now, what is the manner in which you give a clean opinion in a fair presentation framework? The exact words quoted in the standard are, you say, in our opinion, the accompanying financial statements presents fairly in all material respects in accordance with the financial reporting framework, that is Companies Act, for example. Or you can also say, in our opinion, the financial statements give a true and fair view in accordance with the Companies Act requirements, the Companies Act, or the way we say applicable accounting standards specified under Section 133. Either manner of reporting is appropriate. So either you say present fairly or give a true and fair view, it is the same. So I have often come across a fight happening that no, we want to say true and fair view. That is more harsher, more strict, and present fairly is a little less strong opinion. There is nothing like that. Both of them mean the same. If the client or the person requesting you is trying to trick you that by saying presented fairly, your responsibility is far lesser, that's wrong. The responsibility is the same as an auditor. Okay. The next part is the compliance framework. A compliance framework reporting is basically you only need to check whether the financial statement complies with a certain framework. We are not going for a true and fair view opinion. So the opinion would read in the manner that the financial statements are in compliance in all material respects with, let's say, the requirements of a particular regulator or the requirements of a let's say a group accounting policy or let's say prescribed accounting policy for that particular sector. So it becomes confined. It maybe is just a checking on it's like a checklist that is it in compliance. The audit does not involve going further into forming a true and fair view. Now, there are very few instances of these, but it's necessary to know that this compliance framework is there in SS 700 as well. So a regulator may prescribe a certain amount of reporting which can go under a compliance framework. Yes, just wanted to highlight now some terms. The general purpose framework. Normally, the general purpose framework is prescribed by the statute. So we have the Companies Act. Of course, Schedule 3 is our framework, right? We report under Schedule 3. All our reporting disclosures is prescribed by Schedule 3. If we do not comply with Schedule 3, we say that it is not fairly disclosed, right? So, and Schedule 3 is accepted across. Everybody in India knows Schedule 3. Every bank, every creditor, every shareholder is aware that Schedule 3 is prescribed, and it becomes easier for them to understand the financial statements if everything is in Schedule 3. Similarly, Reserve Bank of India for banking companies has their framework, which is given in the banking guidelines. So so if you're a company, you need to comply with Schedule 3, and you need to comply with the RBI regulations, which is the banking regulations. To the extent they do not clash, of course. So the banking regulation would have an upper hand. So Companies Act has to be complied, but banking regulation becomes the main act, and to the extent it is not in conflict, you need to comply with Schedule 3. Then we have the same way IRDAI. They have also issued their requirements, how to form the financial statements for insurance companies, what will be the role of the actuary, what kind of reporting is additional reporting of the actuary, all that is prescribed by IRDAI. So we have Schedule 3, and then we have IRDAI requirements to look at. Similarly, for trust, we have the Indian Trust Act largely, and we have the SBI Act, the IIT Act. These are like specific acts which will have their own requirements mentioned inside their statute. So if you are an auditor of a trust or insurance company, bank, of course, but if you're an auditor of an entity which is statutorily driven by an act which governs it, you need to get into that act to see what is the framework prescribed there. Like in companies, we had Ind AS converged, right? But banking companies came later. So the Banking Act was not changed that way. So in same way, in case of trust, you need to follow the older accounting standard, not Ind AS. Same way, when you look at various other acts, you need to go in and see what is applicable, and you have to show compliance with that framework and then give your opinion. Okay. Some of the other general purpose frameworks which globally accepted: IFRS, US GAAP, and every other country's GAAP you can call as general purpose: Singapore GAAP, Dutch GAAP, Swiss GAAP, etc. Yes, while we will get into this, this is the last part of the report, but the signature of the auditor is a very, very important part of the report. We often see lapses, but this is the exact requirement. Since the standard is prescribed by the SA, the Standards of Auditing issued by ICAI, it is necessary to write the name of the partner. You have to write the firm name. You need the membership number. You need the UDIN. None of these can be skipped. Although outside India, there is a different practice in some firms where they sign in the name of the firm. But in India, my suggestion to everyone, it has to be signed by the partner or the proprietor. No other person in the firm can sign the audit report. As I said, there are certain practices outside India where it may be another person, but in India, it is always the partner and the proprietor. Your manager or no one else can sign the audit report. And it has to be in personal name, personal signature, okay? And you have to mention the membership number, the firm registration number, and of course, UDIN, which is mandatory on all the reports. And every single report, whether you are giving it to the management personally because he requested you to do a job for you, or you're giving it to the shareholders, it requires a UDIN. Every assurance engagement, a certificate, any report requires a UDIN. I just wanted to make that very clear to everyone. The next part is a joint audit. If you're doing a joint audit, the joint auditor and you both have to agree on the report. So it has to be shared, it has to be discussed, it has to be agreed. And then both of you have to sign the single report. Okay, so it takes some time, engage with them. It cannot be done on the last day. And since this SA 700, both will have knowledge of the audit report. What mainly needs to be looked into is the reporting of matters, maybe one qualification from your side, one qualification from the other auditor, but both have to agree and sign the report together. If there is a disagreement between the joint auditors, a separate report should be issued by each of you mentioning that fact. I won't get more into this because joint audit is covered under SA 299, which is very detailed, recently revised, and very well put out. All the responsibilities of every auditor, the management, everything is defined there well. Next, there are some, so this is an important slide. There is something that has to be seen. Like when you ask me, Alim, are you comfortable with the audit? If you ask me this question, this is the exact things you need to be confident on to issue your report. Okay, I'll go through them one by one, and you will yourself realize maybe you missed it out sometimes in the high pace of work. But these are the things which the standard is also saying and makes logical sense as well, that we need to be confident on all these matters. Okay, one, compliance with the reporting framework. Of course, it goes without question. We are always focused on compliance with the reporting framework. That is the Schedule 3, Ind AS, IFRS, AS, all the disclosures. That is the reporting framework. Perfect. We always look at that. Second, we also need to apply our mind. Is there any bias in the management's judgments in preparing the financial statements? Now, these are those matters like, let's say, useful life, right? Useful life is a management, is an estimate, is a management judgment that how long will this machine or plant run. You need to be skeptical for any bias in their judgment, because maybe they want to show less profit, so they may give it a longer life. So they want to increase profit, they may give it a longer life. They want to reduce profit, they give it a shorter life. So depreciation goes up. So look for bias in management judgment. So it's necessary to take a step back, look at all the judgments involved in the client, in his accounting, and just look back and see, okay, yeah, he's doing everything properly. Okay, these are all reasonable. The next one, continuing with that is, are all the accounting policies disclosed properly? They have to be appropriately disclosed. When I say appropriately, it means you need to sufficiently mention. You cannot just write inventory is valued in accordance with AS2 or Ind AS 2. Okay, it's not sufficient. You need to put some information so the person who reads it understands how the inventory has been valued. So it has to be appropriate, and it has to be consistent with the financial reporting framework, of course, right? So this is sometimes, if you go through, especially in smaller entities, whenever we go through, there's always scope for improving this part. There's always scope for re-looking at the policies and saying, okay, it can be a little better. We can think about it again. So this is something, again, as an auditor, your responsibility to see that all the policies have been disclosed properly. Accounting estimates made by the management are reasonable, of course. All estimates for intangibles, all estimates for depreciation, useful life, impairment, these things are based on certain estimates made by the management. I'll give you a very good example. In the COVID area, a management showing me a projection where turnover is going to double next year is something I find unreasonable. Okay. And I've seen it, and they say, no, don't worry, COVID doesn't affect us. We will have a double turnover next year. It's not reasonable, so you have to get into that. Okay. So when you get such kind of projections and such estimates made by the management, please go a step further and see, are they reasonable? It's not our job to just take it and document it. Correct? The next two are those requirements that give us a lot of flexibility with our report, which no framework says. But if we as auditors in our professional judgment feel that we need to achieve this, okay, we can force the client or tell the client that you need to put this information in the report. If not, I may qualify my report. So you have to see whether the information presented in the financial statement is relevant, reliable, comparable, and understandable. Now, this is very, very important in case of disclosure by management in the notes. When they pick up the notes and they want to disclose the material events, managements many times try to, limit. They would like to mention as less information as possible. And if you question them, they may say, look, I have disclosed it, and the requirement is to disclose. So I have no other responsibility further. So as auditors, it's our job to see, is the matter presented relevant for the users? Is it reliable? Is it comparable? Because there may be a similar stand last year, which has changed this year. It needs to bring out that correlation. Is it understandable? Especially if a client has moved into a new business, they would like to bring out some facts about their mergers or acquisitions. They need to give the information in a way, especially for complex standards like derivatives and financial instruments, convertible securities. These things, when presented in a note, need to be a little more elaborate, little more understandable for the common person, the shareholder who reads the financial statement, because it's not necessary that every person reading the financial statement is highly financially literate. So this is where we need to step in and say, okay, no, your note needs to be a little bit elaborated. It needs to be a little well formulated. Okay. The last one is the adequate disclosure for users to understand the effect of material transaction and events. While what I said recently already covers this, now I would like to explain to you how this can be used, how this responsibility puts us in an advantageous position. Now, if a client is not making adequate disclosure of a material event in his financial statements, and you as auditors sign off the financial statement, then it is considered to be a misstatement, a material misstatement of your audit report. Okay, so you were supposed to qualify your report because of inadequate disclosure, but you have not, because you did not. We often don't realize that if the client does not adequately disclose the material transaction events, we as auditors should qualify the report. So you should open up the standard and show these kind of paras to the client that, look, if you do not put the right disclosure, adequate disclosure, I am supposed to qualify the report. And the standard is drafted in such a way it will support you all the way to getting your view across. If you quote the para to the management or to the owners, they will appreciate that, yes, the standard is clearly saying it needs to be disclosed. We cannot do away with it. This is something very good that the standard has and allows us to use our judgment and professional skepticism on how to make disclosures better. So to conclude, so when you go for an audit report, you want to issue an audit report, you have to be sure compliance with material reporting framework, no management bias, accounting policies are properly disclosed, estimates are reasonable, all the information presented is relevant, reliable, comparable, understandable, and adequate disclosures made for all the material transaction and events. So when you have this confidence that, okay, this is all done, at that moment, you can go ahead and issue your audit report. If you feel that these are not achieved, please spend some more time, get confidence, and then issue your audit report. Okay, so that summed up what you need to be aware of in issuing an audit report. I have been covering the SA700, so that deals with an unmodified opinion and what you need to have in place. We'll look at modifications in the next session by Yusuf. Now that we've understood how do we give an opinion, let's look at what the standard is saying about what are the contents of an audit report. Okay, the format of the audit report now is consistent with the international ISA. So very easy to relate, but to keep it relatable, we have to ensure that we do not overstep any requirement mentioned in the essay. So I'm going to quickly run you through these requirements, and they are so important. I hope that you will appreciate the sensitivity of even playing with even one of these requirements mentioned on the screen. So the first one, the title, it has to say this is an independent auditor's report. While it may sound very small, that, why is this required? It is a sign to the world that auditor report should stand out. Mention it is the independent auditor's report. It's not the management auditor or the internal auditor's report, which could also have a similar title. So that is why the reason independent auditor's report, which clearly tells the world that this is a statutory auditor's report. The second, so this title has to be there, okay? It is a requirement. You cannot do away with it also, okay? Second, the addressee. The addressee has to be clearly mentioned. It is mostly the shareholders in case of the companies. In case of government entities, it will be the relevant board of trustees, managing committee, whoever's the governing board on those places. In case of the management appoints you to do an audit, then it will be the addressee should be the management. This is very important because your engagement letter should be signed in such a way that it defines who is the addressee of your work, because he is the one who's going to rely on it. And if he has not engaged you or it is not statutorily required, you cannot address your report to any other person. Okay, you cannot address it just to a creditor or anyone. The management, unless you are appointed for that purpose, you must address it to that person only. Okay? Because tomorrow he is the person who can get up and question you. So be careful who you're addressing. The third thing that comes right up on the report is the opinion para. As I mentioned earlier, opinion para is standardized. So you will know whether it's opinion, qualified opinion, adverse opinion, disclaimer opinion. The opinion para first on the report, right on top. If a person reads that, he knows report is qualified or not qualified. After that starts the basis of opinion. The basis of opinion has to be well written. Certain para has been defined, and then you need to mention the exact reasons why you are qualifying the report. So that needs to come out in specific detail, what you are qualifying, why you are qualifying, what is the non-compliance, what is the quantification. That all comes out in the basis of opinion. And there can be multiple bases of opinion because there could be multiple matters. But all of them have to go there in that para. It cannot go in another para. Then there should come, if there's any uncertainty relating to going concern, this is a requirement coming from SA 570, which is on going concern. So any requirement, any material uncertainty with regard to the going concern assumption needs to get reported right below the basis of opinion para. So any reader is immediately aware that while going concern is fine, but there is some uncertainty in this company. After that comes your emphasis of matter para, which we will cover later today in 706. Then the key audit matters, which is 701, applicable for listed companies. Then comes the information other than the financial statement and the auditor's report, which is under SS 720, where we need to review the annual report and all the disclosures in the annual report. And, we need to mention if there's any inconsistency with the annual report or the audit or our understanding of the audit. After that, that's our reporting part, where our part ends. Then comes the management responsibility part, which is a very clearly laid down para on what is the responsibility of the management with regard to maintenance of books, internal control, going concern, specifically brought out. These paras are standardized by SS 700, not to be tampered with, not to be changed. If your management tells you, no, please remove this part, this is not my responsibility, I'm sorry, we should not touch this para, because standard itself, auditing standards themselves are saying that management has to take on this responsibility, and only then we are going to do the audit. Okay, so do not easily accept any tweaks on this para from your client. Please consider in depth. The next para is a very, very detailed para, which I was very happy to see when it first came out, is the auditor responsibility. So I was amazed the first time it came out when the standard was revised, and I was so glad to see that is the first para where we tell the world what we have done. Till today, we were only telling the world we gave a true and fair view on the financial statements. With this para, now we tell the world that I'm looking at risks, I'm looking at going concern, I'm looking at the estimates, I am looking at the key audit matters. I have reviewed them. I have considered the internal controls. Okay, so there's a para there that talks that I'm going to review the internal control. And if reporting on internal financial control is applicable to the company, you can retain that para. And if reporting on IFC, the internal financial control, is not applicable to the company, then you need to change that para to say that I will not be issuing any opinion. So it is so detailed, telling the world what all are my responsibilities. Okay, and the last part deals with the structure of the organization and the presentation and disclosures as well. So it's very clearly, if tomorrow anyone asks me, what is your responsibility as the auditor, I will tell him to go and read this para. And hence he will appreciate my work and he will not question me unnecessarily. Right? And so I'm very happy to see that para. And I would like, and as you know, this is the standardized para. It is not to be edited. Okay. It's not to be edited unless factually, which I mentioned a couple of cases, it's not to be edited. It should stay the way it is, and no edits should be done on this. It can either form part of the audit report in a para, or it can even become an appendix to the audit report. But if we make it an appendix to the audit report, please sign the appendix as well. Okay, that's just one part of information I wanted to give you. We then have another matter para, which we will cover again in 706, which deals with our responsibilities. Anything regarding our report or our responsibilities need to be mentioned here. Then there's a report. So that concludes the report on the financial statements. Then comes the report on other legal and regulatory requirements. And we'll see that. And there's a signature, which I spoke about, UDN mandatory. The place and date of the signature also very, very important. Please note the date is the date the partner signs or the proprietor signs, and the place is the place the partner or the proprietor is putting the signature. Okay, it is not the place of the registered office of the firm or the registered office of the client. No, or the place of the board meeting. No, audit committee meeting. No, it is the place the partner puts his signature. Okay, this is clarified. Let's move ahead. So I've covered the major part to what I wanted to explain. Quick recap: how should you issue your auditor's report? What should you consider? 1, make use of the prescribed format of the audit report. 2, you modify the standard format as per your requirements, very factually. 3, before you sign the audit report, look at these 2 very important documents: your query sheet by your team, all the closing matters mentioned on that query sheet, which you have discussed with the management. Let your report reflect your work. Do not make the mistake where there is a contradiction between the 2. That is the worst day an auditor can see, right? Because if there's a difference in the 2 and your file is under review, it will become a very difficult situation. The second is a summary of misstatements. We all know we collate the misstatements that we identify. If it exceeds materiality, you may have to qualify your report. That will be covered in the next session. So I won't go much into that. But just before you close your file, before you sign your report, you need to see these 2 matters very critically and make sure that they are supplementing each other. They do not contradict. Document all your supporting and working paper for the audit opinion. That has to be there on the file. Ensure that all the necessary documents have been received before issuing the audit report, like the management representation letter, SS-70 related documents like the annual report, director's report, draft for review. All those documents should be received by you, reviewed by you, and documented. Now you are ready. You can go ahead, issue the audit report. Right? We'll look at modification next session, but this is where you are now ready. So this is something you need to take care of before you issue audit report. Now, so true and fair review is done. Now we are on the legal and regulatory requirements. Like I mentioned, this is prescribed by the statute. This is a reporting requirement. You need to go line by line, what is the requirement, and you need to answer the question. Okay. For just information, everyone, I have just laid down the requirements of 143.3. There are a number of clauses which go A, B, C, D, continue. Quickly run you through them just to refresh. Whether he has sought, so when we say he is the auditor, so there is a specific question that have you obtained information, explanation, which is the best of your knowledge and belief. So if you have not received any information and you are qualifying your report due to non-receipt of information, you need to mention it here as well, that okay, except for the matter mentioned in the basis of qualified opinion, we have received all the information expression which were necessary. So in these clauses you can like sort of disclaim or qualify these clauses by saying except for matters described in the basis of qualified opinion or in the emphasis of matter or in the going material uncertain going concern. You can mention them and you can then give this assurance in the report. So many a times everybody forgets that the qualified opinion mentioned at the top of the report may have an impact here as well. So you please go through these. Once you're ready with your report on true and fair view, go through these points and just think once, are any of these points to be qualified with respect to the qualification in the main report on the true and fair view. So whether you received all the information, explanations, whether proper books of account by law have been kept by the company, whether report from the branch office has been received by the branch auditor. It's very rare nowadays, but it still happens. So the clause is still there. Whether the company's balance sheet and profit and loss dealt with in the report are in agreement with the books of account. So whether reconciliations are not received and you are not sure whether what's mentioned in the books of accounts is appearing in the balance sheet, is reconciling, you can choose to mention or qualify that point here. Whether the financial statements comply with the accounting standards, this will of course be seen in your qualifications para. Any observation or comment of the auditor on the financial transactions or matters which have any adverse effect on the functioning of the company. So here you need to take a step back, look at all the observations in your qualified opinions, emphasis of the matter, and you need to decide whether it has any adverse effect on the functioning of a company. Like for example, in the going concern, there is a problem in raising finance, and the company may have trouble in the next year if don't raise finance. So that could be a point which has an adverse effect on the functioning of the company. So take a step back, read it, and you will know. There's a lot of guidance on 11F available. There's a separate guidance was issued by ICI. You can read that, and it will properly guide you what to report here. So there is a special guidance on F and on H. So F and H, 143.3 F and H both have detailed guidance. There's a single document which has guidance on these two matters issued by ICI. The next question, whether director is disqualified, we all know this section. We need to take representation from them. Any qualification, address remark relating to maintenance of accounts and other matters connected here with. As I mentioned, this again you need to see if any of your remarks above in the main report has any impact on this clause. So then you need to disclaim this clause. You need to qualify this clause. Again, 11, it's H, so there's a lot of guidance available. Whether the company has adequate internal financial controls placed and effective operating units of such controls. This is the clause that deals with reporting on internal financial control. So if it is applicable to the company, then only you need to report, otherwise it's not required. J, such other matters has been prescribed, in which 3 matters have been prescribed. For brevity, I'll just be quick. Reporting on the pending litigations, reporting on the material foreseeable losses, and reporting on funds to be transferred to Investor Education and Protection Fund. So whether there's any delay in that transfer. So these are all prescribed. Now, the new clauses that have come in very recently applicable for this year is 11E and 11F. In this clause, I did hear Sanjay sir say that we will have a detailed session on this, but I will just run you through quickly. This reporting has to come under the report on other legal and regulatory matters. It is related to something disclosed in Schedule 3, the new requirement for disclosure in Schedule 3. But they have put the onus on the auditor to take a look once what management is reporting there. So to break up the clause, I'll tell you what it says. So the clause E has 2 parts. One is funds given by the company, and one is funds received by the company. They relate to either given or received. So we'll talk about given. Now this clause says that the company should not have given funds to any person, okay? And he should not have advanced those funds to any other person, okay, on behalf or on the instructions of the company to any ultimate beneficiary. So it is basically a clause to capture where the company has moved funds out, not directly to a related party or not directly for any purpose which is prejudicial, but they are doing it indirectly through an intermediary. So a company gives funds to someone else, that person gives it to someone else. That manner of giving can be advance, or it can be loan, it can be investment, it can be a guarantee, okay, and it also can be a security, okay. So for example, let's say I have a subsidiary where I have no limit of investment, so I advance funds to my subsidiary gives it to somebody else, but that is for my benefit. So the MCA is trying to capture those kind of cases here. The second case deals with, so the more detailing of the clause is that it talks about whether it is in record in writing or not. So I give money to somebody, that somebody gives money to someone else, whether there is an agreement or there is no agreement. We have to identify, we have to do certain procedures and mention whether that other fund has been given to someone for the benefit or for means given to someone by or on behalf of the company. So it could be any person, and this is little complicated to report. I'm thankful that ICA has released a very detailed guidance implementation guide on this, with all the scenarios where, let's say, you lend the money, company gave money in the first year, and then it was lent to another person in the second year, then in which year we need to report it. So all those kind of scenarios, permutation combinations have been covered in the implementation guide, which everyone should read before reporting on this clause. The second part deals with the other way, when any other person has given given the company any money, where the company is the intermediary, and whether I have given it to someone else on his instruction. Okay, so it's the reverse case that someone else is giving me money and I have given it to somebody else. It's again possible I may receive the funds in 1 year, have an agreement in the second year, lend it in the second year. So I need to report it in both years. I need to take care, and the second year you need to report when I advance the funds to somebody else. So just a quick, I try to explain what this clause is all about. But yes, we are still to see reporting on this. It is the first year, and we need to see how companies are starting to report these matters. The third assurance we have to give that we have done some audit procedures, and they are considered reasonable and appropriate, and nothing has come to our notice that has caused us to believe that the representation 1 and 2. Basically, we need to take representation for both the matters up 1 and 2, and then we need to do some audit procedures which will let us believe that those representations are fine, because of course the management is doing it. It is not easily traceable, right? So we're getting a representation of the management. So implementation guide is providing all the scenarios, the audit procedures, and the confirmation formats are all available in the implementation guide. So I request everyone to read that, pick complete guidance from there and work on this clause. They require auditor to report whether there are any transactions other than those reported in the accounts. If funds have been, so it's a negative way of reporting. So we say that there are no other funds other than those disclosed in Schedule 3, right? Then, like I said, if it's invested in 1 year and utilized in the second year, we need to track and report. It includes direct and indirect investments, and also includes like some guarantee and security. So we need to be very careful when we report these matters. It covers both money received as well as lent and invested, which I earlier mentioned. So I'll leave this there because further guidance is available, and probably we're having another session on this detailed session. The second question is fairly simpler, whether dividend declared or paid during the year by the company is in compliance with Companies Act. So Companies Act has a section 124, which is detailed on 123 is detailed on the dividend, and we need to do the reporting with which on the dividend declared and paid, declared and not paid, or paid in the next year. All those scenarios will be covered here. Paid up to the date of the audit report or later, and interim dividend is also to be covered. So again, a lot of guidance in the implementation guide. You can read that. A brief touch on the new section coming in next year, where we have, well, absolutely. This is the ultimate check, where we are required now for periods beginning 1st April 2022. This clause has been postponed for some time now because of the technical challenges in achieving this in India, across India. The clause states, the G clause that will be coming out is whether the company has used accounting software for maintaining the books of accounts, and whether that software has a complete audit trail, okay, and the audit trail feature is not tampered with and has been preserved by the company as per statute requirements for record retention. So this is something where totally deal with the software. All clients need to upscale their software to come to a level where they can prove this to us, and it will need help of IT experts. It will need companies to upgrade their softwares, run trial runs, and bring their accounting system on a more advanced level. So this clause has been deferred, but I'm sure when it comes, it will be very helpful for the audit field and bring a lot of credibility to the field, because now softwares themselves will have audit trail which will not be tampered with. So let's see this in the next year. I look forward to it. these are some of the last I would like to state is all the publications given by ICI, which can really help in us in making the audit report. So the first very good guide is the implementation guide on the reporting standards. So 700, 705, 706 all are in detail covered here. The guidance note on audit of the console CFS. So for console financial statements, we have a particular guidance note dedicated to it. So when you're preparing a console, please refer to that. Revised guidance note on reporting on fraud under 143.12. This is when you have to report on fraud in the audit report. You need to look at this standard specifically, this guidance note. Guidance note on reporting on 143F and H, which I just mentioned. The implementation guide for 11E and 11F also, which I just recently mentioned a few minutes ago. These are all ready and available on ICA's website. The guidance note on bank gets revised every year and is available. Caro guidance note that came out recently, of course, tremendous help from there. There was a multiple choice question on the guidance note on Caro again, which is also very helpful. And of course, the guidance note on audit of internal financial controls or financial reporting, which came out some time back, but most useful for us to plan the audit of the IFCs where applicable. So my effort today was to cover the importance of SA 700 and how it makes a base for us to take our decisions to make other changes. I believe I've covered everything that I had to cover. And I've tried to put forth the basics of the standard. I am hopeful that each of you can take it forward. And when you use the standard to make your reports, this is helpful and you do not miss any clause, any requirement. And we do really good reporting for the season and all seasons going forward. Thank you very much. I am done with my part of the session. I'd like to hand it over back to ICI team and for Yusuf to take it forward.
Thank you so much, sir. Thank you so much, sir. Can you hear me?
Yes.
Yeah, it was wonderful deliberation, sir. We have made a lot through your deliberation. And today we are having 2 hundred speakers, yourself as well as Yusuf Kakalwala. So after your technical session, now I request Yusuf sir to please start his deliberation so that the rest of the topics related to this audit conclusions and over to Yusuf sir, please. Sir, kindly minimize your screen. Yes, sir. Yusuf sir.
Yep.
Namaskar, Yusuf sir. Welcome to you.
Hello. Good evening, sir. Good evening, sir. Thank you for this opportunity, sir. Ji. I actually.
Sir, we will take all the questions relating to this at the end of the Yusuf sir's presentation. Fine, sir.
Okay.
Fine. Over to Yusuf sir, please.
Okay. Thank you, sir. I will take this opportunity to first thank everyone at ICI and especially Sanjeev ji and Vishal ji for giving this opportunity. Also, a very good session by Aleem, my dear friend. And he has created a good base. I think he has taken even qualifications into account. So I've given a little bit just about the qualifications and all that. So I think it is quite a good base for everyone to they have got a good insight about how SA 700 reports are given. So the basics, the contents, the form and content of SA 700 has been explained in detail. Taking further, I will continue with SA 500 and SA 706. So just a second, I will share my screen. If someone can confirm my screen, is it proper? It is visible?
Yes, it is fine, sir.
Okay. So now SA 700 has given the contents of how the audit report should be given. So SA 700 is giving you a detailed format. What is compulsory, what is mandatory, what is optional, like when it is applicable, you have to insert, when qualification is there, how you have to insert. So SA 705 and 706. 705 concentrates specifically on modified audit opinion. So, and SA 706 covers emphasis of matter and other matters. Now, these two standards are basically quite critical, along with 700, of course. Of course, they come in random together with SA 701, that is key audit matters, and SA 720, that is other information. Now, all this standard SA 705 and 706 are why they are quite a lot of emphasis is given on, and why they are so critical is basically mainly the external reviewers who are reviewing the audit reports and the work of auditors, like peer review is taking place, the quality review board, even the NAFRA. So when they assess the audit report, the conclusion, because this is the only deliverable which compiles our whole understanding, our conclusion, our assessment about the company. So this deliverable is extremely important, the audit report. So 705 and 706 are a negative. 706 and 706 is just an information, but 705 is a negative comment. So any negative comment coming, it is extremely important, and it should be backed by adequate documentation. Our understanding, the auditor who is giving a qualification, an emphasis of matter, an adverse opinion or a disclaimer of opinion, giving a modified opinion is actually a very difficult, because we will be facing quite a lot of hiccups from within our own assessment, as well as the management. So the management will always be, of course, on the negative side, and trying us to reduce the qualification, or maybe reduce from qualification to emphasis of matter. But the assessment from our side, based on the work which we have performed, the adequate documentation, that should be the thing which will provide us a guidance, which will provide us enough support to give a proper audit opinion. Whether it should be an EOM, it should be an other matter, or it should be an qualification, modified opinion. It should be properly backed by proper adequate documentation and a proper professional judgment. All these external agencies, their main focus, or the main point on which they are challenging the auditors, is basically the judgment, the professional judgment which the auditor is taking. Why a qualification given by the auditor can't be an adverse opinion? Why there are 4 to 5 qualifications in an audit report, and why those were not assessed to have a material and pervasive impact, so that the auditor could, and the auditor, why did not he give an adverse opinion? So these are some kind of judgments, the professional judgments which we need to take, and that should be clear, crystal clear, before issuing any audit report. I will go in detail with respect to this, and when I go in detail, I think I will be touching upon this SA 705. So SA 705 is addressing the form and content of the auditor's report when a qualified opinion or an adverse opinion or disclaimer of opinion is given. It gives a clarity on in what scenario a qualified an opinion can be qualified, adverse, or a disclaimer can come. SA 706, which the revised standard, it addresses the requirement to include an emphasis of matter or an other matter para in the auditor's report, and its placement, the wordings, how it can be properly drafted. All these things are getting covered in the standard SA 706. SA 705, when we talk about SA 705, so the normal audit opinion which Alim took us across was SA 700, when the auditor is giving an unmodified opinion and concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting. Now this is a clean opinion. There is no issues, nothing. Now, how there is a modified opinion? The modified opinion may be because of two reasons. When the auditor is concluding that there are sufficient appropriate audit evidence has been obtained, and the financial statements are not free from material misstatement. That is, there is some material misstatement involved, maybe at a normal account level, or maybe at the financial statements as a whole, or the auditor is unable to obtain sufficient appropriate audit evidence which will enable him to conclude that the financial statements are free from material misstatement. So there are two scenarios. there are 2 points. One is a material misstatement, and the second one is a pervasiveness of the impact. If the financial statements are materially misstated, misstatement, I will take it upon that when a financial statements are prepared as per any applicable financial reporting framework, there are certain factors which we need to, certain aspects which we need to check upon. The compliance is checked. That is a recognition criteria, measurement criteria, classification, and presentation and disclosure. Now, most of these things come from your accounting standard NDAs, and certain things come from based on the Schedule 3 or other regulations which are applicable to the entity. Now, the financial statements is proper, is given, we give an unmodified opinion when applicable financial reporting framework is complied. Now, there can be a misstatement. A misstatement is when there is a difference between what is to be reported by the management of financial statements and how it has been reported. So the difference between that two leads to a misstatement. Now, if this misstatement is such, the materiality involved in this misstatement is such that the financial statements as a whole is materially misstated, that is a pervasiveness, then it can be adverse opinion or a disclaimer of opinion. And when an account is misstatement is misstated, then it is a qualified opinion. Now, the material misstatement, normally it is a tendency that we take the material misstatement based on the amount involved. So if material misstatement is not only because of the amount involved, but it needs to be also considered because of with the recognition, not only with the recognition measurement criteria, but also with respect to the inappropriateness of the classification or presentation or disclosures. Now, Schedule 3 disclosures, if they are not complied, it is a misstatement. It is a non-compliance and it leads to a material misstatement. Now, how many, what was the significance of that non-compliance? How many schedules were not complied? How many Schedule 3, how many other non-compliances were there? That needs to be assessed to identify whether it should be an EOM, it should be a qualification, it should be a adverse opinion accordingly. Now, in this case, I will also like to state that the effect of material misstatements is that since the audit opinion is issued by us, the material misstatement should be assessed based on the materiality which we have identified for the respective entity. So it is the materiality which we have identified for the course of our audit, and the material misstatement should be accordingly decided. Going back to this screen, the material misstatement is involved and the pervasiveness. Now, pervasiveness means that when pervasiveness captures the effect of material as well as possible misstatement. Material misstatement is the impact has already taken place. We are already having enough evidence, and we can calculate the impact of the misstatement. Whereas possible misstatement is where sufficient evidence is not available or sufficient information is not available, and we can just conclude that the impact, if any, because the amount of the financial account which is involved is material. So the impact will be material, but so it is a possible misstatement. There will be a misstatement, but amount cannot be justified as of now. So but the amount which will be hit will be a material. So that is material possible misstatement. Pervasiveness can either pervasiveness can either be if there are multiple qualifications or multiple negative points with respect to a lot of areas, like inventories. There is a qualification with respect to inventory. There is a qualification with respect to revenue, and such other areas. So which overall covers impacts the materially as the financial statement as a whole. So 50% or 60% of the areas which of the financial statements are qualified. So that leads to a pervasiveness. Similarly, there can be a scenario that one line item, one financial account is so important in the financial statements that it covers a major part of the financial statements, maybe an investment or maybe an inventory, which covers 60 to 70% of the whole financial balance sheet. Now, if that amount, there is a qualification, which is a major qualification on the entire amount of that financial account, that is maybe based on valuation or maybe the physical, there's some other issue. then if that qualification, that also, even if it is a single account, that will become a pervasive misstatement. So if the financial statements are materially misstated, so the misstatement is financial is material, but the impact is not pervasive, then it is a qualified opinion. But if the impact is material and pervasive, then it is an adverse opinion. In this case, we have obtained sufficient appropriate audit evidence and are able to conclude that based on our audit procedures, that the area or the financial statements are materially misstated. So, and the other scenario, we are unable to obtain sufficient appropriate audit evidence. And if we are unable to obtain sufficient appropriate audit evidence, and if we are able to conclude based on our understanding and our audit procedures that in absence of this appropriate audit evidence, the amount which will be impacted, or the areas, the financial accounts which will be impacted will be material but not pervasive, then it will be qualified opinion. And if the impact will be a pervasive thing, then it will be a disclaimer of opinion. Going forward, if when we speak about disclaimer of opinion also comes up with respect to scope limitation. Scope limitation is basically when the management of the company limits our scope, tries to avoid giving us information, or tries to they are not in such a position that they can provide us enough information, then this can lead to an scope limitation. So in such a case where there is a scope limitation, the first step should be that as an auditor, when we have already accepted the engagement, and when we have already started auditing, and in between or maybe at a fag end of the audit, the management comes and tells us that so much information cannot be provided. So in such a scenario, we first need to discuss with management. If they still don't agree, we need to communicate with those charged with governance, that is the board or audit committee as applicable, and simultaneously explore ways to perform alternative procedures based on which we can get enough evidence to which is an alternative to the actual evidences. If this is also not possible, we need to determine the possible effect of undetected misstatements. That is, if suppose the entire valuation impact of inventory has not been given, or maybe investments, the fair market value, the market value has not been given. If enough documentation for bank confirmations or bank statements even they have not been given. So what will be the impact of the possible effect of undetected misstatements? If the impact is likely to be material but not pervasive, then a qualified opinion can be issued. But if the impact, if you assess and the impact is material and pervasive, then it is a big issue. The first thing which we have already discussed with two charged with governance, and the impact is so much high, then we need to consider withdrawing from the audit. This is actually even given in the implementation guide or guidance note given by the ICA on resignation of auditors, that where in such a scenario arises, we should withdraw from the audit. But we need to also assess whether it is permitted by applicable law or regulations. An example can be SEBI. In case of listed companies, the SEBI has issued a circular that in case as an auditor we have carried out 3 quarters, and then we need to carry out a 4th quarter as well. So in such a scenario, where we are not in a position to withdraw from the audit, we need to give a disclaimer of opinion. So disclaimer of opinion is the ultimate step where we need to assess after the thorough assessment, we need to decide. These are some of the illustrative qualified opinions. These are purely illustrative based on various audit reports which are there in the market, and people have given the qualifications over a period of years, which we have observed. So maybe for naming, I will say it is a valuation of inventory, carrying value of investment, non-compliance of accounting standards, in impairment of assets. If the valuation of impairment of the impairment hit is not the assets are not properly impaired, as on the there are criterias or there are trigger points based on which impairment is noticeable, but the management has not properly impaired, or they have not even considered the impairment calculation, then and the impact, if done, if the impairment is taken place, we are able to conclude that it will be material, then a qualified opinion should be given. Gratuity actual valuation, the gratuity is need to be valued by the actuary as per the accounting standard and Ind AS. But if the management is not carrying out an actual valuation, and they are doing it internally, unless it is a small company or a company which has an exemption to do it from actuarial valuation, if they are doing it within the organization and they are not complying with the accounting standards NDS, then a qualification can be given. Also, if gratuity actual valuation is given and the impact is provided by the actuary, sometimes management take a stand that the impact is too high and the assumptions are not proper. We have guidance from the peers what industry what assumptions are taken by the various players in the industry, and the assumption taken by the management is not justifiable. Then we have all the we can assess and we can identify whether the impact, if properly taken by the management, whether it would have been material, and if it is material, then it can be qualified. In case of valuation of inventory, an illustrative qualified opinion has been given here, wherein the management has not stated the inventories at the lower of cost and net realizable value, but has stated only at cost. So this is a departure from the accounting standards, and accordingly, the impact, since the impact was material, the management has the auditors have given a qualified opinion. Now, in this case, one more thing which needs to be considered is here. There will be scenarios where, in case of qualified opinions, management will not give a note in the financial statements. So, in case of it is unlike EUM, where the proper note in the financial statements is already given. In case of qualifications, it may be our observation, and management, of course, will not give a negative point in the financial statement. So, we have to highlight this when we highlight this in the qualified opinion. Reference to note to the financial statements will not come. So there will be multiple scenarios. Sometimes there are points which are already given by the management and they are giving their explanation, their positive impact, and we are still qualifying. There may be a difference, so we will be qualifying. So we will give reference to the audit to the note to the financial statement and still give a qualified opinion. So we will come across that. And when we are giving an impact, the impact is known. Where it is not known, it's okay. But where the impact is known, we know the amount, how much write down should have happened. We need to even take the disclose in our audit opinion. In our opinion, what will be the impact on other financial accounts areas. So like cost of sales in inventory, if it is getting impacted, my cost of sales or my revenue will be impacted, or my income, my tax impact will come. What will be my impact on my net equity? So accordingly, my profit, equity, how much it will be reduced or increased, the respective impact needs to be conveyed. As I said, now this qualification pertains to a carrying value decrease in the proper value of investment. So here a detailed note is given in the financial statements, and accordingly the auditor has also referred to that note in the financial statements. In this scenario, the subsidiary of the company has ceased operations, and they are incurring significant losses leading to net worth. So the investment which the holding company is given has in the subsidiary companies, the value which has been carried in the financial statements is not proper, but the management is positive based on the restructuring scheme and a resolution plan that they will be able to get back the carrying value. So there will be no issue with it. So accordingly, in case the significance of the carrying value which is involved and the assumptions which are put in by the management, the the stand which the management is taking, that is dependent on some outcomes, on the maybe the future availability of natural gas is there, outcome of sale of barge is there. So accordingly, the auditor is not able to comment on the carrying value. So the scenario is there. I am fully aware of the information, but I am unable to make a comment or unable to make a final conclusion. So in such scenario where only an area is impacted, it is a qualified opinion. This third one is with respect to any non-compliance of any accounting standard or NDAs. Of course, in when we are telling that we are complying with the financial when we say the compliance with financial statements, it is compliance with accounting standards or NDAs. If there is any accounting standard or NDAs has been has come in and is effective, and we are not able to comply, the management has expresses inability to apply the adopt the NDAs or accounting standard. In such a scenario, if we are able to whether we are able to identify the impact or no, and we might be knowing in such a scenario, okay, if a company is having a lease of suppose 100 crores or something like that. So the amount which they are taking, and they are having an idea that it is material. Accordingly, they will give a qualified opinion, since it is a non-compliance with the standard and the impact will be material. Now, the disclaimer of opinion and adverse opinion. Now, disclaimer of opinion and adverse opinion normally do not come with one single point. There are very rare cases where a single point will lead to a disclaimer of opinion or adverse opinion, because there are a lot of things which there are so many areas, and there may be a scenario where the management is unable to provide evidence for sufficient appropriate audit evidence for so many areas which might be material to the company, and accordingly we conclude that there will be a disclaimer of opinion. Or there may be so many qualifications or maybe material misstatements in so many areas where we have got the information and material misstatement has been identified in multiple areas, and then we can conclude that there's an adverse opinion. So this this example has been taken from the standards on SAA which ICA has issued, and in first scenario the disclaimer is given when because the management is not allowing access to the financial statements or allowing a communication with the component auditors, which and the components are form 90% of the total net assets of the group. So accordingly, since the impact is so much material that I'm not able to get a comfort on 90% of my total assets of the consolidated financial statements, the auditor will of course give a disclaimer of opinion. In case of adverse opinion, this is a pure example of a going concern issue where the entity's financing arrangement has expired and the management is unable to decide get anything future cash flows. The company has even filed for bankruptcy, so it means that the company does not want to continue. But still, the company, the management has prepared the financial statements on going concern basis. If that is the scenario where the going concern assumption is not correct, and the financial statements are still prepared on going concern basis, then an adverse opinion needs to be given, not a qualified opinion. In case of as per 570, I would say as per SA 570, in case of going concern scenario, normally a material uncertainty with respect to going concern para is given, which is like an EOM. And then an adverse opinion is given, since the basic going concern assumption is not proper. Now, important points. These are most of the things we checked. So I summarize some important points with respect to SA 705. So when qualification or modification is happened in the audit report, opinion para, basis of opinion para, and other legal and regulatory requirements. These are the major changes take place in these sections. When the auditor's report is modified, we also need to check whether this might have an impact on the IFC reporting. So we are not covering IFC reporting, but just a touch upon if a modification, any point is modified, any financial statement area is modified, then that might even have an impact on the controls. So maybe the controls are not effective. So that thing can be checked upon. It might not be a scenario that every time any qualification or modification is coming, the controls will not work properly. Such scenario can be when there is a disagreement with the management in interpretation of an accounting standard. So accounting standard the management is following, but that is an interpretation issue. So in such a scenario, qualification will be there because we have that is an interpretation of the management, and there is a disagreement with between the auditors and the management. But the IFC controls are properly working. Professional judgment. Now, whatever we did with respect to SA 705, it is basically comes down to the professional judgment of the auditors, how they and assess what will be the impact, whether it is material, pervasive. That is a professional judgment. So, and this professional judgment will be different from case to case, person to person, the auditor to auditor. So, the the professional judgment is difficult to prove why at a certain period of time, why on a certain specific time, why the auditor took a certain decision and he gave a qualified opinion and not an adverse opinion. So each and every opinion which the auditor is giving, it should be backed by sufficient facts and circumstances which are known to the auditor, maybe even at up to the date of the auditor's report. Subsequent events also we are checking. So if subsequent based on the even there's any change in the subsequent events and the auditor feels that his opinion should change, that he should change it. And whether the judgment which reach it's in fair it is in compliance with the application of auditing and accounting principles, it is proper, appropriate, the financial statements are correctly disclosed. If anything negative is there, a proper modification or EUM should be given. There cannot be multiple audit opinions. This is a unique question which is also there in the implementation guide and by the ICI, that there may be scenarios where we will not have obtained certain information for certain areas. Maybe a couple of areas we have not obtained sufficient appropriate audit evidence, and in case of certain areas we might have a material misstatement. Now we need to assess what is the maximum impact. If there are too many material misstatements in areas which are material and pointing towards pervasiveness, as compared to an area, a single or a couple of areas where sufficient appropriate audit evidence has not been obtained, then instead of a disclaimer or giving we can't give two opinions. So instead of disclaimer, an adverse opinion, which means that the true and fair view is not correct, which should be given. There is no true and fair view is not correct. So that should be given. Moving on to SA 706. So SA 706 is basically emphasis of matter and other matters. Now, emphasis of matter is quite detailed standard. It deals with additional communication by the auditor's report in his audit report. On financials, it is drawing an attention to some matters which are already presented or disclosed in the financial statements by the management. They have adequately disclosed, but these matters are of such importance that they are fundamental to the user's understanding. Example, we will say like a COVID thing. The scenario was such that everybody is knowing that COVID has taken place and it will or it might impact most of the entities. So the note on COVID has been given by the entity properly, but still we are drawing an attention because it might be a game changer. It might lead to certain impacts in the future, or it might lead to impact on the balance sheet items, the balance sheet balances which are there in the financial statement as on our reporting date, and maybe they might not be realized. Maybe so the future is uncertain. The impact is uncertain. So there may be there are various kind of scenarios in case of EMs. So an emphasis of matter para and an emphasis of matter para is not a substitute for a modified opinion. So where qualification is to be given, a qualification should be given, and the EOM is proper where there are no issues with the management. It is just only to highlight a fundamental impact to the users. Fundamental can be said that which is already important tool for the financial statements and disclose in the financial statements, because it is if it was not fundamental, it will not have been disclosed in the financial statements, right? So it is already present in the financial statements, and we are bringing out something important in that point to the users of the financial statements. Disclosures in the financial and is not even a substitute for disclosure in the financial statements to achieve fair presentation. Financial statement disclosure has to be made. It can't be that has been given and proper disclosure is missing in the financial statement. So should be given only when there is a proper disclosure. Nothing less than a disclosure will be allowed. So disclosure has to be there, and then an which will refer to the disclosure. Or reporting in accordance with 570 revised. So for 570, that is going concern, material uncertainty on going concern para is to be given, and is not a substitute for that. If anything pertaining to going concern, it will be reported as per SA 570. When we compare with other matters are those matters which are not present, which are other than presented or disclosed in the financial statements. So if anything is presented in the financial statements, it should go either in emphasis of matter, or if required, maybe a qualification. But other matters are such things which are not in the financial statements. But they might be relevant to the users, not fundamental. They are relevant. The users might get additional input. If they might get additional information if they check these items. So it is like previous there was a previous auditor who had audited his financial statements. So the financial statements, the comparatives were not audited by me and was audited by the previous auditor. This is just an information which I'm giving to the users, so that the users doesn't conclude that I'm taking comfort on both the things. I'm taking the comfort, but it is based on the previous auditor's financial statements. Other matter paragraph does not include the following information, which is required to be disclosed or presented in the financial statement. Like we said, that anything which is disclosed or presented will not come in the other matter. Information which is required to be provided by the management. Now, there will be a scenario where the management is required to be provided, like management responsibility is there. So it is the responsibility of the management. If a disclosure as per Schedule 3 is to be provided by the management, it is not my concern or as an auditor to provide that disclosure in the other matter para. No. It is something which is required by to be disclosed in the financial statement. So they have to disclose there. Whatever is to be provided by the management is their responsibility. They will provide. I'm just pointing out something which will be relevant to the users over and above all these things which is provided or disclosed in the financial statements. There may be certain information which might be prohibited from providing. So in case if I'm not allowed by any law, maybe because of a confidential or ethical point of view, I should refrain from giving in the other matter para also. The following, there are certain some circumstances that may require an EUM. So an uncertainty relating to future outcome of an exceptional litigation or regulatory action. So a company has a litigation or a case is going on with respect to recoverability of advance of tax. So I have filed for refund, but the tax situation, the case is going on. Based on the legal opinion, lawyer's confirmation, I can conclude that the favor is the outcome will be in the favor of the company. But I don't know what will be the final outcome. Currently, the lawyer is confirming that yes, the outcome will be in the favor of the company. So okay, we are not taking any hit or we are not doing any provision because it is in our favor. But it is an uncertainty. So because of this, since we are relying on something on a legal confirmation, lawyer confirmation, so then we should give an event. A significant subsequent event that occurs between the date and financial statements and the date of auditor's report. So maybe there may be a fire, or there may be some natural calamity which might have taken place, or there may be an update in the group change. The management might have changed. Certain thing which might be of quite an importance or a relevant or fundamental impact, or Schedule 3, some changes have come in between. I've finalized the date of the financial statements 31st March, and I'm reporting on 30 April. some changes has come in the accounting standard. So anything which is a subsequent event and a significant one which might have an impact on the financial statements, I need to disclose it to the as per EUM. Early application were permitted. In case of an accounting standard, example, you can take like Ind AS 116. Ind AS 116 was applicable from 1st April 2019. Now, some companies went for early application and they report and they did reporting of for financials for year ended 31st March 2019 as per India for Ind AS 116. Now, when they are disclosing anything as per the new standard, there's quite a lot of change. Now, this is an early application, not mandated by the by the standard. Now, wherever the mandated by the standard, it is already in compliance. Early application is in compliance, but it is something which a user should know that the early application has taken place. So EUM is required. A major catastrophe, maybe a COVID scenario which took place, maybe a huge fire, a blast has taken place, maybe a terrorist activity has taken place, which might have led to any damage to the factory or the business of the organization. That major catastrophe can that has and continues to have a significant impact on the entity's financial position. So it is having an impact as on the date, or maybe post even in the future also. So and EUM where uncertainty also lies. So in such a scenario, EUM to be given. Examples of emphasis of matter, we can take there was an impact of COVID when in the last 2 years, people have, quite a lot of auditors have started giving an EUM on COVID. So they are drawing attention to the financial statements and describing the uncertainty with respect to the COVID. In such a scenario, but whenever an emphasis of matter is given, the most important thing is we are drawing an attention to the note of the financial statements, and finally we are concluding our opinion is not modified, because there is no modification. Modification is 705. 706 mein modification nahi hai. 706 is purely just an emphasis. We are just emphasizing on something which is properly given by the management, and we are telling this can have an impact in future, or this might be is a little bit different to be watched upon. Pending litigation. A penalty has been imposed by something, or a tax litigation is going on. So based on the legal opinion which the company has obtained, the company believes that it is a good case in their favor, and accordingly we are fine with it. Since legal lawyer confirmation is obtained and we have assessed what is the impact, what is the stand, where does it actually stand in the court. When we have done proper checking, we have done proper audit with this around this point, and we conclude that the legal confirmation or the lawyer confirmation which has been obtained by the company, which has independently obtained by us, is proper, then in such a scenario, considering the uncertainty of the outcome, we should give an emphasis of matter. And we don't know whether provision was required to be made considering the uncertainty. Effects of in case there's a fire in the organization, in the premises of the company, and a major impact has taken place to the company's production facilities, or maybe factory or something like that. Then in such a scenario, it is quite important. Maybe the records of the company might have been burnt out. So in such a scenario, we need to check whether there will be EUM, or even maybe if required, if we have not yet finished the audit and the documents are not available, then we might have to assess for the qualification also. So this kind of scenario is maybe further assess for a modification. Certain other examples which were there with respect to emphasis of matter was non-compliance with respect to Companies Act and scheme of merger and demerger. Now, when a scheme of merger or demerger happens, in the year when the scheme of merger takes place, to update the users about the merger which has taken place. The management is already giving a detailed note about the merger and the impacts, the accounting, and the where the goodwill or capital reserve has gone. So the detailed note is already there in the financial statements, but only to inform the users about what has happened. What is so material in the company which has happened, or such a big thing has happened. So EUM should be given. non-compliance with related to Companies Act. In case there are certain sections of the Companies Act which, if there is a non-compliance, the penal impact or the penal repercussions of those sections will not be so material. Like in case of maybe in case a whole time woman, there's no woman director in a company. If no woman director is not there, the penal provisions are maximum maybe around 5 lakh. If a woman director is not appointed. So it is a non-compliance of a Companies Act, but the Act itself gives a final maximum amount of the penalty which will be applied. If the maximum amount of penalty is 2 lakh, 5 lakhs, 10 lakhs, and that amount is immaterial to the financial statements, immaterial as per our materiality which we had calculated for the purpose of for audit of the financial statements, then at least an emphasis of matter, because this is an important thing and it is a non-compliance of any standard or it is a non-compliance of a Companies Act or any other law, that should be mentioned. Of course, the impact is immaterial, so it is an emphasis of matter. Other examples of other matter. In case of other matters, physical verification of inventory was not carried out during the course of COVID. And then evidence was obtained. We had obtained alternative evidence like rollback procedures was covered. So when alternative procedures were covered as per SA 501, then in such a scenario, an other matter was mentioned. These are basically based on the procedures which we have performed. We are just highlighting that the core procedure of physical verification we were not able to perform, and we were not able to take a comfort on the existence of the stock. But however, we have done alternative procedures and overall and have obtained a comfort based on alternative procedures. But the main procedure was not performed. In case of when India's transition took place. So the first year when India's transition is taking place, of course, the comparative financial information was maybe audited by us or maybe the previous auditor. It would have been in AS scenario. So here other matter is given that the previous auditors or we had done the comparative financial information in accounting as per accounting standard. Opening balance sheet was done as per accounting standard, and the adjustments as per Ind AS has been verified by us or audited by us. Where the financial statement was audited by another auditor in previous year. This in case of other matter is given only in case where we are appointed for the in the first year. So if we are newly appointed auditor and the previous year financials was done by some other auditor, we have to highlight this fact to this is a relevant point to the user of the financial statements. Other matters on balancing figure. This is basically purely related to SEBI. That is the SEBI LODR reports which are going on. Maybe at the year end when the results are going on, then in the LODR report we give a statement point other matter that the statement which is given, that is the financial results and for the quarter of March is the balancing figure between the audit financial statements for the audit figures of the 12 months and the published unaudited figures or audited figures for the three quarters. Another audit matters comes in case of consolidated audit report. In case of consolidated audit report, we need to ensure, first thing is we need to ensure that all the modifications or emphasis of matter which comes in the standalone audit reports of components are taken care in the consolidated audit report based on the materiality. So in case as per SA 600 also, when a guidance, an announcement was given by ICI way back in 16-17 that if modifications are there in the standalone reports of the components, we don't need to directly copy paste it directly in our console reports, but we need to assess it based on the materiality, whether it will be the qualification of a subsidiary, whether it is so material that it should be a qualification for the group as a whole, or it should be a emphasis of matter for us. So it needs to be assessed. It needs to be assessed in detail, and then a proper a qualification or EOM or something like that where required should be given in the consolidated final audit report. In case of consolidated audit report, the other matter para which comes, it includes normally 2 points. The other points which are there in the standalone reports will also continue where as applicable. But there are 2 other points, a couple of points which comes. One where the component is audited by another auditor, and other when the component is not audited by anybody and management financials are taking place. Here I have put in a para for the in a scenario where the component is audited by another auditor. In case the component is audited by another auditor, in such a scenario, we write a note that the financials of the so much subsidiaries, joint ventures, associates, these have not been audited by us, whose assets, total assets, net assets, total revenues, cash flows, all these are mentioned. And we state that this financial statements have been audited by other auditors whose reports have been furnished to us, and we have relied on those audit reports with respect to the SS700 report as well as our report in terms of section 143.3. So we are, even for IFC, we are relying on their report. In case of SS706, certain important points which needs to be kept in mind is that emphasis of matter is to be given only in respect of matters which are represented and disclosed in the financial statements. And in case there is any issue with the treatment of the matter which is there in the financial statements, or we have any reservation about that matters, we need to qualify. It is only where we don't have any reservation. Matter is disclosed in the financial statements properly, but we have any reservation, qualify. If we don't have any issue, give an emphasis of matter. Widespread use of emphasis of matters is not recommended, because if you are giving 8 to 10 emphasis of matters in an audit report, the impact or the effectiveness of auditors' communication is diminished. Emphasis of matter is only to bring out fundamental, highlight something fundamental in the financial statements, which the user should take knowledge about. If there are too many such things which need to be emphasized, we need to identify which is more important. And if everything is important, and we need to assess whether there should be any qualification angle involved in it. There can't be that everything is so emphasizable. Insurance claim was raised, and this year we received an insurance claim which is of X amount. It 100 crore balance sheet, and we have got an insurance claim of 15 crores. If proper disclosure in financial statements is made, we need to assess why emphasis of matter is required. Because if proper disclosure is made, what additional are we going to do? What additional input we are giving by just giving an emphasis of matter? Emphasis of matter or audit or other matters cannot be a substitute for CAM. Now 701 I think was covered up in recent times by WSE. So in the CAM key audit matters, they have their own importance. Certain matters which are discussed with those charges governance need to be taken care with CAM. But if they are so important, they are already disclosed in the financial statements and they can be disclosed with emphasis of matter, then either give a CAM where required. Since judgment is involved, certain other criteria are there which are pointing towards key audit matter, give a key audit matter. Don't replace it with EOM, because in EOM you don't need to explain any procedures, you don't need to give any further details. So people are just disclosing EOM and not giving a key audit matter. This is not a substitute. I think most of the things I have properly touched upon. So I will once again say a very thankful. I'm very thankful to the ICI and Sanjeev ji, Vishal ji, everyone. Thanks a lot. Any questions? I'm happy to answer.
Thank you so much, sir. Yusuf sir, for your wonderful deliberation. Alim sir is also here. Alim sir, you are there? Yes, Alim sir is already there. So both the deliberations are wonderful, sir, and full of knowledge. And we have gained a lot through Yusuf sir as well as Areem sir's deliberation. Sir, we are having some questions for both of you. So that is up to you who is going to answer the relevant question.
Okay.
The first question is, how auditor would know the movement of funds as per clause 11E and 11F?
Right. So, valid question. So the guidance has come out. So let's a few points we can take which will guide us towards the answer. One, we have to take a representation from the management. So first, management has to come forward and provide us the information first. Then starts our step to verify that agreement. Okay. So management is first required to make disclosure in Schedule 3. He will, let's say, make certain disclosure. We will discuss with management, understand. Since auditors, we are aware of the funds flowing or invested or lent by the company. So if the management specifies that I have given so and so amount to certain person, our work starts there. Then he will say there is an agreement with that person to invest somewhere else, or what is the purpose of those funds. We can inquire that with the management, then get representation from management first level, and management can get representation from that other party, what he is doing with the funds. And those formats are given in the implementation guide. So I believe it will have to be a sequential process where we'll have to go and start documenting, and then only we can give the assurance, answer the question. But I appreciate that question. No one has done it so far. This is the first year. There will be some challenges.
Yes. Sir, if the company has made some additional disclosures in regard to financial statements in its notes to accounts, like non-deduction of TDS under Income Tax Act on certain expenditure, is it incumbent on the auditors to qualify his audit report to express an modified opinion instead of unmodified opinion?
In case additional disclosures have been given, I think there is no non-compliance of Schedule 3 or any other standard. So it is voluntarily somebody is giving additional information. So rather, instead of a qualification or emphasis of matter, I would say it should be a clean opinion. But in case the thing is so relevant, it is already given in the financial statements, and the auditor thinks that it is fundamental. It is not fundamental as of now because it was not required as per the Schedule 3. But it is relevant to the user of the financial statements. They may highlight it in the other matter para if required.
Yeah, if it is a very substantial matter and it is something that needs to be brought to the user's attention, we can put in the emphasis of matter also, and that be more better place. Okay. And this is a tax audit matter. So I'm not sure why that person would disclose it here, but probably we need to take care in the tax audit. Non-payment of TDS.
So verification of dues to MSMEs in financial statement is a very challenging job. Most of these small companies are not having the data of their supplier. So how to deal this in auditor's report?
So in case they are not having enough sufficient data, and they are not able to disclose, their disclosure is also impacted. If they need to assess on the impact of the misstatement. The misstatement is not there, but if sufficient appropriate audit evidence has not been obtained. So in case the possible misstatement which is involved, if they are able to identify, they may give a qualification or adverse opinion based on that. Or rather, I would say disclaimer, not adverse, a disclaimer, because there's a possible misstatement involved. And disclosure of MSME, yes, it is required by Schedule 3. So if enough details is not available and they are not able to disclose in the financial statements, it will be a non-compliance of Schedule 3 also, the Companies Act. So they need to take it all the things into consideration and then decide whether it is so material that a disclaimer is required or only a qualification is sufficient. So since only one area is there, I would say a qualification will do based on the materiality involved.
So if director's report is not available, then how to deal in this SA 700? How to report as per the SA 700?
Sorry, which report is not available?
If director's report is not available, then how to report as per the SA 700?
I think sorry.
Yeah, I think he's referring to the para of 720 that comes in the audit report. So then this you need to go to SA 720, which is the relevant standard that deals with other information. 720 has given two options. If you get the information before you sign the audit report, verify and report. If you do not get the information, you can mention in the report that I have not received the information, I am going to receive it later. Then the responsibilities in case of listed companies, you need to, if you get the information later and you check and you find out that there are problems, mistakes, then you need to go back to management and inform them. I think in case of private companies, you do not need to go back to the management later or report again later. You can inform the management, but you don't need to revise your report later. So please refer SA 721 and also refer the implementation guide on 720 that has an FAQ on these matters. That will be very helpful to you.
Yes.
Yes.
So when there is a qualification regarding inventory valuation,
Right.
the ratios which is to be given in accounts after considering the qualification or before considering the qualification. In qualification, whether auditor has to quantify the amount which would impact on profit.
Ratios will be, of course, on the amounts which have been taken by considered by the management, because ratios are, of course, they are to be disclosed by the management. So they will not give a different figure for, they will not take a different amount for ratios. They will take the same amount. Second question was with respect to the impact on the profit, right?
Yes.
Impact on the profit. So impact on the profit, if we know what is the, if we are able to identify, detect what is the impact of the misstatement, of course we should give it. If it is we are not able to identify what will be the misstatement, it is uncertainable, means it is a possible misstatement, then we can cite that we cannot comment upon the impact as of now.
There are two more questions, sir. Investments by the company exceeding the prescribed limits under Companies Act, is it qualification or EOM?
By the company, as per the Companies Act limit.
As per under the Companies Act, investments by the company exceeding the prescribed limit.
Okay.
Referring to the 186.
Yeah. So it is a non-compliance of this section, right? Companies Act.
Non-compliance of the okay.
It is a non-compliance of the Act. So then I think we need to again assess the non-compliance with the penal I would say what is the penalty involved in it. The non-compliance is there. Normally for Companies Act, whatever sections are non-compliant, there is a non-compliance of any section, they have a penal section, and if not there, then they have a general penalty section. So how much impact of that penalty will be there, we need to assess. If the impact is material, I think then there will be a qualification. If the impact is non-material, then at least an emphasis of matter, because non-compliance of Companies Act is there, it should be given. At least an EOM should come.
So there is one more regulatory question relating to the taxation like GST. Our member is asking about where a search has been conducted by GST and entity has deposited amount under the protest and show cause is not yet received. Entity is disclosing the fact in the notes. Is it a EOM to be given?
They have disclosed, the management has disclosed in the financial statements, right?
Disclosing the facts in the notes, yes.
In the notes to the financial statements. Now, anything which is given in the financial statements, if it is a fundamental, then it should be an EOM. Now, this thing, it is quite important to if it is material and quite important to the users of the financial statement, I would say we should give as an EOM.
Fine, sir. Fine, sir. So these were the questions relating to today's reporting, audit reporting. We have gained a lot from both of you's deliberation, and you have justified with your all the presentation for relating to 3 essays.
So on behalf of AASB of ICI, I extend my heartiest thanks towards both the speakers, Aleem ji as well as Yusuf Pagalwala ji, for sparing your valuable time. And once again, for acceding to our request on a very shorter notice to deliberate today. Thank you so much, sir. On behalf of ASB, once again, thank you, Aleem ji. Thank you, Yusuf ji. Thank you so much.
Thank you so much. It was our pleasure today.
Thank you, sir.
Thank you, sir. Thank you. Namaste.
Thank you.